we have a few videos where we've spoken about investing in buy-to-lets, but today we wanted to focus more about being tax efficient with your buy-to-lets. So let's get into it. Hello, welcome back to our channel and podcast. My name's Gemma, and here at WS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Iftika here with us. Iftika is a trained accountant and mortgage advisor who's been in the industry for over 10 years, and he is also one of the founding directors here at WIS. Welcome back, Ifti. How are you doing today?
Oh, very well. How are you doing, Gemma?
Very good, thank you. So the first thing that I wanted to ask you is, how can you be tax efficient with buy-to-lets?
So with buy-to-lets, usually there are different types of taxes. So the main tax that people will pay every year is your income tax. So with the income tax, how it's worked out in sort of a basic way is your income minus your expenses, and whatever profits you make, you pay tax on that. Obviously, as an investor, you would love to have maximum income, right? So that's a factor that you really can't control, but you want more of that for sure. But where you can be tax efficient is if you can maintain your expenses properly, because this is where a lot of people fall. Obviously, I'm an accountant. I look at people's tax returns every year. They come to me, and when we say, okay, so where's your expenses? Most of the people say, here you go, right? So then it only adds up to a few lines, right? Then when we ask other questions like, okay, what about this and this and this? Or they're like, oh, we did spend that. Either we don't have the receipts for that, which is not helpful, or they've sort of not taken those into account because they're like, I completely forgot about it, so we'll just leave it out, and they kind of miss out, right? So you can't miss out on your expenses. I always tell people you need to put your expenses hat on all the time, right? Because when you spend money on the house, you need to think, okay, do I need a receipt for this? Can I maintain this? Is it something that will help me with the taxes? So you need to think about that when you're an investor, because that's how you become tax efficient. So you have to make sure that you maintain your expenses. That's the key thing. Yeah.
Okay. So then who needs to file a tax return?
Most landlords will have to file a tax return. I think there's one big exception. If a landlord in that particular tax year has earned less than £1,000, then you do not have to file a tax return. But apart from that, everybody else who owns a buy-to-let and who's let it out and gets rental income, they need to file a tax return. So that's one of the only exceptions you have. There are a few subcategories which you can think about as well. There's something called a rent-a-room allowance, right? Now that's not really buy-to-let as such, but if you have a spare room in your house, you can rent it out to somebody else. So if your income is below 7,500, you don't have to file a tax return either. So rental room allowance is kind of an exception. This is the one that gets a lot of people. So just be a little mindful of this. Some people say, oh, I've got a limited company. I'm a company director, so I don't need to file a tax return, right? I think that's a misconception. Yes, you don't have to file a self-assessment tax return because you're a buy-to-let investor, but because you're a company director, you need to file a tax return. So don't fall short on that one, right? So if you're a company director, you need to make sure that you file a tax return as well, right? So there's no exception as such for that, right? It's a compulsory thing for company directors most of the time.
Okay, yeah, so watch out, guys. What's the taxes that you need to pay then as a property investor?
There are about 7-8 types of taxes in the UK. As a property investor, at some point you will end up paying almost all of these taxes, right? As a property investor, let's say you come and buy your first property. The first thing you pay is stamp duty, land tax, right? So a lot of people stop at stamp duty. It's not duty, but it's stamp duty, land tax, right? So that's the first tax you pay when you buy a property. So most of the time, if you're a buy-to-let investor, you anyway pay 3% additional stamp duty, so there's no getting away, right? So that's the first tax you pay. The second one is your income tax. So income tax is based on the profit you make. Every year, you have to pay a tax. You file a self-assessment tax return and you pay a tax, right? So that's the second tax you pay. That's the most important one because that's the recurring one. So every year you have to keep doing that, right? And also things like VAT. You don't have to register as a landlord for VAT, so don't get me wrong there. But you have to incur VAT. So for example, if you're hiring an estate agent, the estate agent will charge you VAT. Unfortunately, you can't claim it back because on residential properties, there's generally no VAT if you're letting it out. So therefore, you can't claim it back. So invariably, that becomes a cost to you, right? So VAT is something you can't get out of as well. So that's tax you pay. Then if you sell the property, you pay capital gains tax if it qualifies. Obviously there are thresholds for capital gains. Sometimes you do make a capital gain, but there are certain deductions that you might have. For example, if you live in that property, there's an allowance. There are certain allowances that HMRC gives you for the last few months that you rented it out. You don't qualify for capital gains tax as well. So there are a few exceptions, right? So when you take all that into account, there's capital gains tax you have to pay as well. Most people will pay that. So that's the fourth type of tax you pay. Then, unfortunately, when you die, there's inheritance tax you have to pay as well.
More tax.
Right? So, yes, I know. You're not paying tax, but your estate is paying tax, right? So effectively, it's you, right? There are things people do sometimes to help. There are sort of methods. Some people pass on properties next to skin. It's a conversation you need to have with your advisor or your accountant, right? So there is inheritance tax that you need to be mindful. Inheritance is about 40% tax, right? So that's quite a hefty bill. Usually what happens with inheritance is, say, if you have a property, if you die, generally if you're kind of married, it passes on to your spouse, right? So you generally have a 325,000 allowance, spouse has a similar allowance, so it becomes double. But if there's anything more than that, obviously your estate pays tax, right? So that's something that you'll have to think about. The last sort of thing is something like corporation tax. Now, corporation tax is not applicable for buy-to-lets on individual names, so you don't have to worry about that, thank God. But if you are a limited company buy-to-let, which is becoming very popular now, a lot of our clients are doing limited company buy-to-lets. With them, there's corporation tax you have to pay, right? So all in all, there's about 6 taxes that you may have to pay, right? So you might not pay all of these, but some of them you definitely will have to pay.
Yeah. And income tax, that's been a topic that's been talked about a lot recently. Can you just briefly explain to everybody kind of how it works for anyone that doesn't know?
Okay, cool. So with income tax, what happens is you pay taxes on the profit you make. So let's take the most simplest example. Somebody owns a property. So if the person makes, say, a rental income of 10,000, they are allowed to deduct expenses against that property. So if you have maintenance costs, then you pay estate agent fees. You might have repairs, all that kind of expenses, running costs. So the difference between the two is your profit. So you pay tax on that. Now, the main reason why people talk about income tax these days is because of something called Section 24. Now, that came into play this financial year. So nobody has seen the full effect of it yet because they haven't paid tax for this financial year. So with this financial year, what happens is the interest element that you pay on your mortgage, if you are a high taxpayer, cannot be deductible as a cost anymore. Of course, HMRC gives you a 20% allowance, but apart from that, majority of it you cannot deduct, right? So that's why people talk about income tax a lot these days. It's because of Section 24. I think we've done a few videos on this before, right? But Section 24 is the main reason why people talk about income tax and property these days, right? But that's not the only thing that you need to be mindful of. There were a few changes that happened a few years ago. Some people get this wrong still because there's something called a wear and tear allowance. So in the past, if you go back about 3-4 years ago, HMRC used to allow you to deduct something called a wear and tear allowance. It used to be something like take all your assets and 10% of that value you can deduct as a cost, right? So by default, even if you don't buy assets, you're allowed to deduct that. But they don't allow you to do that anymore. So there's no more wear and tear allowance. So that also has been a topic. So therefore, that affects your income tax as well because now you've got to replace something. So for example, let's say you let out a property, you got a fridge, the fridge is not working. If you replace it, yes, you can deduct the cost. But in the past, you didn't have to replace anything, right? So I think the whole idea is to encourage landlords to have newer stuff as you go rather than just leave everything as it is, right? Because with wear and tear allowance, sometimes there's no motivation, right? So it sometimes helps the tenant, right? So I think that's kind of the thinking behind it. So because of those two headings, that's why income tax has become a topic to talk about the last few years and certainly this year for sure.
So then, would you say that expenses are kind of key in determining your tax now then?
Yeah, expenses has always been the key. You just need to make sure that you pick up whatever expenses you can. So let it be you're replacing a fridge or let it be estate agent fees. You need to make sure that you maintain those receipts as much as you can because that's the one that will decide your final tax number. Because like I said, you want the best rent for sure. As an investor, you'll always want the highest possible rental income that you can get. So that's really not controllable. But expenses, I always tell our clients, right? Self-assessment, you don't need to have an accountant. but sometimes worth spending that money on an accountant, because they will give you advice or they'll give you tips on what expenses you can claim and things like that. So if you know what to do, your tax bill will be lower, and obviously it's worth paying the accountant because he'll help you save money, right? So expenses are sort of a key thing in deciding your tax bill. So that's, I think, what's the most important thing.
So then what have you got to do to kind of get these expenses? Have you got to provide receipts and things, show evidence?
HMRC will always insist on receipts, right? So you just need to make sure you maintain your receipts. There are one or two exceptions, but most of your expenses should have receipts. You could call a plumber in, you could call an electrician if there's any sort of repairs that needs to be done. Just make sure that you keep your receipt. Often I hear people say, I've paid my plumber, say, £200. It's in my bank statement, right? See, I see, ABC Plumbers Limited, right? Well, that's not good enough because that's only in your bank statement, right? What HMRC would love to see is what this receipt is about, right? So what have they done? Yeah. Is it on official receipt paper? So that's something that HMRC loves to see. So just having a transaction in your bank statement doesn't help, right? Okay. Often people ask me questions, that guy is happy to do my work, but he wants cash in hand, right? It doesn't work, right? Cash in hand probably helps the other person, right? I mean, that's a different subject altogether, sort of area which I don't want to talk about. But as far as you're concerned, it does not help you, right? Because it's not going to save you tax, right? So you might end up giving a builder £5,000, but it's not going to save you tax. So if you're a high taxpayer, it costs you 40% more, right? So you just need to make sure that you keep the receipt, right? I think this is what puts people off more when it comes to receipts, because people think you need to keep the original receipt, right? I have clients who come to me and say, I've got a few boxes full of receipts. For the last year alone, I had to have 4 boxes of receipts, right? But HMRC doesn't say you need to keep the original receipt. All what they say is keep it in some form. So you can use electronic. The easiest thing to do, a lot of people have access to Google Drives these days because, I think there's free space on most of these drives. Dropbox and something similar, right? There are so many online applications which you can use. All what I tell you is put the date down, take a picture from your phone, because everybody sort of carries a smartphone these days, and just upload it and you're done, right? Throw the receipt away. You don't need the receipt thereafter. Obviously, if you want to do something a little bit more sophisticated and be a little bit more organized, there are a lot of apps out there. Some of them are free, right? So you can use that. So if you want to be really organized, you can use a software like Xero. It's a proper accounting software. Likewise, there's enough software out there as well which you can use. But I think if you become a bigger landlord, right, the more properties you have, you probably want to go into a system like that. But otherwise, these basic stuff is more than enough. So long as you maintain the receipts, I think you're fine. So
then, what are the types of expenses that you can claim if you're a landlord?
So there are 2 types of expenses. This is the one you have to be very, very careful about, right? One is what determines your income tax in the year. That's called revenue expenditure. And then there's a second type called capital expenditure. Now, capital expenditure is like initial costs, right? So if you buy a property, things like solicitor's fees, stamp duty, the property price itself, and any associated cost to bring the property to the level it's marketable is generally called capital cost, right? And obviously, if you are doing something like an extension or if you're doing some enhancements to what you have, that could be capital cost as well. Now, that's one type of cost. Now, the revenue cost is the one that decides your annual income tax bill, right? So that's the one that people concentrate a lot on because that's the one that's going to immediately save your tax bill because every year you pay taxes, right? So that's the one that decides that. So those are like day-to-day running expenses, right? Like a maintenance cost or estate agent fee. That sort of cost is what falls into that category. You have to be very, very careful with these two. You can't mix up the two, right? Because if you put capital cost into revenue cost, your tax bill will drop, but HMRC won't be happy, right? Because that's not what it's supposed to be. So you have to be very careful with that. So if you're not sure, again, get some advice on these areas because some of those, especially the classification between revenue and capital, sometimes is a little gray, right? So you may need some advice on that. Don't assume that I change the pantry and I can put it as revenue cost sort of thing, right? But if you change your pantry and you've done enhancements or change it completely sort of thing by adding additional cupboards and things like that, it could be classified as capital cost as well. So if you're doing projects like that, you probably want to talk, All
right, well, maybe it'd be easy to sort of do an example for everybody, so say like someone's buying a derelict house to do up and let out. Can you explain how the capital cost and revenue expenses would work for that?
I think that's a good question you asked, Gemma, right? Derelict property is probably the best example you can take. So you bought a property, a derelict property, say through auction. So if there's any fees that you pay to the auction house, that's cost that you have to incur to bring the property to a state where it's rentable, right? So any auction house fees, the house price itself is also capital cost. Then you have things like solicitor fees, stamp duty, and any repairs at that point, because you can't rent out the house, right? Because it's not rentable. So anything that you incur to bring it to a state where you can rent out is classified as capital cost. On that example, it's quite clear because it's easy to explain that, right? But then let's say you rent it out, right? Once you rent it out, there'll be expenses like estate agent fees, boiler repairs, servicing, then the annual electricity checks and the gas checks, that kind of expenses will be classified as revenue costs, right? So any running cost is usually like that, but anything to do with the asset itself, the main asset, is generally capital cost. And there's one other thing that you have to think about. If you're furnishing the property, the assets will be used for a longer period of time. So any furniture you buy for the property is very likely to be classified as capital cost as well. Again, speak to accountants about this because they can guide you on this. Any assets is classified as capital cost as well.
Okay. So then how can you be as tax efficient as possible on buy-to-let properties?
Okay. Like I said, it's mainly to do with expenses. You need to put your expense hat on the time. Whenever you spend money on the property, think, okay, can I sort of classify this as revenue costs? That's quite important. Keep your receipts. For me, there are about 4 types of revenue costs, right? The reason I say 4 types is because it's easier to explain. So when you buy a property and just say you're trying to rent it out for the first time. So my first classification will be pre-renting costs, right? So you'll have to market the property. So there'll be some advertising fee. You will probably have to get an estate agent involved to advertise the property, or people use online platforms like OpenRent to rent out properties. So any cost there can be classified as an expense. Then you got things like inventory costs before the tenant moves in. That is a cost that you can take into account. You are very likely to get a boiler or electric and gas safety certificate. So those you need to take into account as well. And any references you do, and if there's any reference agency fees that you pay upfront, that you can classify as an expense as well. So that's like pre-renting expenses you have. So those are the main expenses you have at that stage. But then the next big category is when you have rented out the property. So when you rent out the property, obviously there'll be a wear and tear. So there'll be maintenance that you have to pay for. Then you'll have annual boiler maintenance costs. Then you will have things like estate agents fees if you're using an estate agent. So those can be deducted as well. So then you have things like replacements. I use this word very carefully because replacement is different. So if you have an asset in the property, like let's say a sofa, and if you replace that sofa with identical sofa, then that cost can be deducted as a revenue cost, right? As I mentioned before, usually furniture falls under capital cost, but replacements, usually you can deduct it in the year as well. So that's something to be mindful of because sometimes people miss this, right? This is what replaced the wear and tear allowance, which I spoke about earlier. So this can be taken into account as well. So that you got that, and some things like travel to the property. So as a landlord, you go to the property and you can do certain maintenance work. Some landlords are very handy, right? So they do the handyman's job themselves, right? So if they travel to the property, if there's an expense, you can claim back. So if you are going to the property and you have some work to do in the property and you have to buy food on that day, because let's say you spend a whole day and you have to buy food because you're gone just for the purpose of doing this, you can claim that cost as well, right? So things like sometimes you have stationery you need to buy. There are a lot of things. All what I say is put your thinking cap on when it comes to expenses. Think, okay, can I relate this to the property? If it is, there's a good chance it's yes. If you're not sure, you ask your accountant, because I can give you a list. Right? I always tell my clients this. I can give you a list, but the list will only cover about 80% of the expenses, right? There is still a 20% which is unknown, which we've not even thought about because it's very specific and it's very
individual.
It's individual, right? So that's what it is. These are the things I find a little funny because some people ask about these certain revenue costs. They say, oh, mobile phone, can I put my mobile phone cost as an expense, right? General answer is no, because a lot of people are on a contract and it's personal use as well. But if you are on a pay as you go and you can very clearly pick up the expenses you have spent on this particular property, you can deduct those costs, right? People have asked can I put a computer to the business, right? General answer is no, because obviously you'll be using it for other things. But if you are a bigger landlord and you have to use a computer for your work purpose, there's a good chance that you can put that as an expense as well. But please talk to your accountant about this, because there's no right answer to that. That's what I said. There's sometimes gray areas. It's always worth talking to an accountant on that one. So those are the expenses you have as running costs. But remember, when your tenants go out of the house, that's the third type of cost you have, right? So there'll be like checkout costs that you have to incur. There might be some cleaning costs that you may have to incur. So those things are costs as well. Don't forget that you can claim those. And the fourth one is when there's no tenants, right? Don't forget that when there's no tenants, you'll have to pay council tax, you'll have to pay water, you've got to pay electricity, irrespective of whether there's tenant or not, right? So that burden comes on to you. So those costs, remember to pick those up as well, because it's all to do with your business, right? So you can claim those. So remember to take all those also into account, because that will help you reduce your tax bill.
I heard there's some exceptions to the rules. What would those be?
Yeah, in terms of exceptions, I think you're mainly referring to receipts, right? One thing is on travel, right? So like I said, if you travel to the property, let's say I'm a landlord living in London, I've got an apartment in Manchester, and there's a problem, I decide to go to Manchester, I can claim travel to the property. I can either pump petrol to the car and I can claim that, or alternatively I can claim mileage, right? So with mileage, you are allowed to claim 45p a mile. You do not need a receipt for that. What you can do is you have to maintain a mileage log, right? So if you've gone to Manchester twice or 3 times, you need to maintain that log. So long as you maintain that, you can claim your mileage. So for that, you don't need a receipt. The second thing is things like home office allowance. This is an important thing. If you're using your home as an office, this may not be applicable for smaller landlords, but the more properties you have, you will be spending time at home trying to figure out stuff to do with the property. HMRC allows you to claim, it used to be £4 a week, but it's gone up to £6 a week now. It does add up at the end of the day, because I think that's about £26 a month, which you can claim without a receipt. So you might as well claim that. But if you are spending a lot of time, there is something called a home office calculator that you could use, where you apportion your expenses in your house to see how much you can claim. That usually works out to more than £26. If you need any help, do get in touch with us, because we are more than happy to share a home office calculator with you. But that works for people who spend a lot of time working at home, right? So that you do not need a receipt, but obviously you need to show some backup as to how you arrived at that number. And another thing is, this is again applicable mainly for landlords who have more properties. You can employ people, so employee costs you can put through as well. Sometimes employee earning less than £8,000, there's no NI to pay, there's no PAYE to pay either, right? So you can pay them. It could be a family member as well, but you should be able to justify that they are doing work, right? You can't pay something for nothing. So that's why I said it's more applicable for landlords who have portfolios or a bigger number of houses. You can employ maybe a family member in your business, so you can pay them a salary. But if you are doing that, please make sure that you properly do it through the PAYE scheme, right? Because you can't just pay people money. So those are probably 3 exceptions where you wouldn't need receipts, yes.
And are there any additional expenses you can claim depending on whether you've got a limited company or Airbnb or like a holiday let or something? Are they all the same?
It's not all the same. I think that's where the biggest difference is, because I think we've touched on some of these on our previous videos as well. So obviously I was talking as a mortgage broker in most of the other videos. Now I'm wearing my other hat as an accountant. The main reason why people would do a Airbnb, most of the time it falls under the service accommodation / holiday let category, or even with limited companies, the main advantage is you can deduct your interest expense. That's the biggest difference, right?
Yeah.
Because with normal buy-to-lets you can't anymore. You just get that 20% allowance, if you're a high taxpayer. But with this, you can deduct your interest in full.
When you're saying interest, you mean on your mortgage, right?
Yes, the mortgage interest. Yes, that's right.
Yeah.
Whereas for most landlords, that's your biggest expense every year, right? So you end up paying 5,000, 4,000, whatever it is, depending on the loan you take. That's always going to be a significant number. So that can be deducted in full, which means your profit will be less. If your profit is less, obviously you pay less tax. And also with structures like limited companies, you pay only 19% corporation tax. I mean, those change a little bit in future, but For most landlords, they still continue to pay 19% tax, right? So that is really helpful. So there is a big difference there.
Yeah, all right. Thanks, Ifti. There's some really good tips in there. So thank you so much for your great advice. I just wanted to put a reminder out there that these points may or may not be applicable to everybody. So please talk to an advisor if you're unsure whether they're suitable for you. If you don't have an advisor, I will leave our WS contact details below, as we are always happy to help. And a little reminder that as a mortgage is secured against your home or property, it may be repossessed if you do not keep up with the mortgage repayments. Thank you for joining us again today. We will be back next week with another episode of Let's Talk Money and Mortgages. Stay safe, have a great day, and we'll see you again soon.